All right. It is the bottom of the hour and it is our monthly call time. Wait, hang on. I just turned off my computer, my camera. There we are. All right, now I'm back. All right. So, bottom of the hour, time to begin. Uh, we are covering the topic of today of the 2025 Manning Napier tax facts document that we posted to the website in our important documents section. There are a number of key changes for 2025 that are happening. So we are going to want to take a look at that, at those changes and proposed changes. Now, I'm going to say this. This is very important. It's January. Congress has to act on a number of these things by December 31, 2025. So we have a lot of year left to cover. Chances are there's some of this stuff is going to change that we're going to cover. And so the purpose of this call is really to put everything on your radar. Uh, Before we dive into that, the usual disclaimers. So I'll give these at the beginning and I'll give these at the end, and then we'll go from there. So item one, everybody's muted and everybody's got their video off. So that way we've got this preserved for posterity in the future. Next is this video is for information purposes. It is not tax or legal advice. It is not a solicitation to buy or sell any security. And the opinions expressed during this call are the opinions of Phillips Financial Strategies and not those of other folks. And we believe this information to be accurate and timely. And so that said, let's dive in. So item one, a little bit of housekeeping. For those of you receiving RMDs and on payment plans and various other stuff, we're going to be reaching out, getting you some items associated with your RMDs because it was a good year in the market last year. So chances are there's an adjustment to your monthly scheduled RMD, and or the RMDs that you have to take throughout the year. And so giving programs, because tax season is like around the corner, oftentimes we'll see some spring giving and matching campaigns. Keep an eye out for those in the mail when they arrive. So if you want to do any giving, let us know right away so we can help you get that, get either appreciated securities or RMDs taken care of. So that's a bit of the housekeeping. We've got a couple of other little housekeeping things that were going on that I won't mention at this exact moment because they're pretty much not essential, but it's, it's our usual Q1 documents and the things that we need to go over, and we'll repost an update to the website, those kinds of things. So just stay tuned for that stuff. You'll see more documents coming. Also, it is the end of the month in January, which means your 1099 has either become available, is about to become available, or will be available in the next couple of weeks. So if you need us to send it to an accountant, let us know. If you don't see it or you need help downloading it, let us know. We will get it for you. And so if you have it and you're all squared away, great. But you'll be receiving your 1099s and or notification about your 1099s no later than about mid-February. Like I said, the bulk of them that I've seen have already started to become available and will have online access here soon enough. Next, moving on to the investment markets. So the theme for this year really is volatility. We're going to see a lot of up and down. We're going to see a lot of movement in the market. There is a lot of froth. I had mentioned that the market is pretty much trading at a premium. To be a prudent fiduciary with portfolios that we've managed, in many cases, what we have done for our investors is we have taken a little bit of risk off the table. We've rebalanced, we've increased some of those fixed income and some of those more conservative positions for this year. And we have started to steer the portfolios incrementally over the course of the last several months to a different allocation, different position. You may have noticed, for those of you that are in some of our individual stock portfolios, that we've traded out a number of stocks over the last 6 months in terms of poor performers, in terms of overall allocations. And the idea is that we simply don't want to be caught off guard and being too aggressive when things are trading at a premium. As I have mentioned many times before, we should expect volatility. Volatility is part of the nature of the stock equity markets and to some degree the bond markets. And so this year will be no different. And as you may have known if you've tuned into past presentations, one thing is true. About every 8 of 10 years, the stock market, the equity markets, particularly the S&P 500 index, has a decline of 10% or greater. That 10% or greater decline is pretty standard and par for the course. That happens over 80% of the time and over 75% of the time in all years, the S&P 500 finishes up more than 10%. So as I mentioned, volatility is going to be part of the name of the game. Be expected and be prepared for a lot of movement this year, as various asset classes get upended and things move around. So with that, if you've got questions about specifics and how it relates to your portfolio and your income withdrawal, I encourage you schedule a meeting right on the website, top right corner. It says schedule. And we'll go over it in greater detail. Moving on, presentation for today. This is the fun stuff. Give me a moment. I want to make sure this is up, and we're going to share our screen. Okay. I'm a little nerdy. I get excited about this document, and so, well, you should too. All right. First things first, IRA contribution limits, not so much of a big deal. Pretty much staying straightforward. What we see is in the top here, we do see an incremental increase in the long-term capital gains taxation rate because of inflation. So this is now increased fairly significantly. What is kind of key here for those of you, if your income is less than $96,000 total, you do not pay any capital gains tax on qualified dividends. The same is true, and then it goes up to 15% for folks married filing jointly once you cross 96,000. And if you are married filing jointly and you remain under 600,000, it's 15%. So that's a key couple of metrics, and there you go. Very important. All right. Now, remember I mentioned inflation adjustment. We see the income tax rate schedules. We see the inflation adjustments here. As a quick refresher on how to read this document. Now, remember from prior presentations, I've mentioned that your tax rate is not an all or nothing flat thing. It is incremental based on dollars. So if you think about the taxation of dollars as a stack, you can better visualize the way this particular chart works. So what you have is that, and I'm going to start here with actually married filing jointly, since most folks are married that work with us. So what I will show you here is that the first $23,000 you earn as a couple is taxed at 10%. Notice 10% of 23,850 appears right here. And so this is a cumulative figure. So if you go through this chart and you look at this figure here, this tail end figure that is here, and you go down to here, this, and you do the math, the 9695 number is the cumulative amount of tax that you will pay for 12% on the 96. So this will give you a good idea about how much tax to withhold for your W-9s and various things with your employer, especially if you are married and you earn significantly less than your spouse, you want to make sure you're withholding the right amount so you don't have any big surprises when you file your tax return. The next thing that's important that I will get into here is you've got income deductions and credits. So let's say just really quickly, you're earning 206,700 as a combined couple, which gives your federal tax bill 35,000. What we want to do is come in here and we want to take our income deductions and we want to say married filing jointly, which is 30,000. You'll take 206,700, you will deduct it, you will deduct 30,000 from it, and then that will give you an adjusted tax bill. You also can further deduct on that same line any money that you put into your 401k pre-tax. And that will help to give you a good rough estimate about what your federal tax bill will be. We can get a little bit more fancy, which we will build on here in a minute in terms of calculating your estimate. Which next brings me to the education side of the ledger and the savings side of the ledger. You'll see that for your 401k plan, you can defer a little bit more money this year. And something really great for those of you that are age 60 to 63, you can put in a special catch-up contribution of $11,250. So this is different than the regular catch-up for 50 plus. This is a special catch-up, which is an extra $11,000. So just keep that in mind. Talk to your HR benefits folks in terms of how you make sure your form is filled out correctly so you can take advantage of that if you are between the ages of 60 and 63. Next addition for this year is SEP IRAs. Now you can now have a Roth SEP IRA, which is new. So those rules now apply. Health savings accounts also added. The out-of-pocket maximums for folks are now quite different. So we've got all these kinds of things. Take a look at these. Some will pertain to you, some will not. Well, I don't want to take everybody's time today and go through this line by line when you can read the chart. Couple of key things on this page. Social Security adjustment for 2025 from 2024 to 2025 is 2.5% increase. But I would throw that out there. The other thing is that we are now solidly in the RMD age of 73, by the way. So the rules are if you turn 73 in 2025, you are going to start taking required minimum distributions. So FYI, okay? These are the key items that we have here. Go ahead and read through them at your leisure. Next item, this is key, is let's talk about things that are going to sunset. Remember, I mentioned about the fact that we've got Congress needs to act. So, a couple of quick things here that are important. First thing, we often talk about the SALT deduction, which caps the deductibility of income, your state paid income. So it's currently capped at $10,000. That is set to sunset this year, which means that this will be the last year we have of it. This is 2025 tax year, unless Congress acts to reinstate it, modify it, continue it, do something. So we shall see there. We also see in this section how a handful of things are set to be reverting, changing, modifying this year. Like I said, well, I'm not going to get into these too deeply because Congress has between now and December 31st to act, and then sometimes even they do some things at the beginning of January following year, so they can say, "Look how we fixed a problem that didn't exist." So I'm not getting into the politics, but keep an eye out for these. This is actually really important. It will affect savings and a handful of things, stuff that you do during the course of the year. Uh, there are some rules now regarding IRS and rebalances and putting money in. This could be subject to you as the IRS implements rules. So make sure you read through this, make sure you take a look at it. Um, this big thing here is the 10-year rule. Um, and this is important for planning. Because if you're thinking, well, I'll save a bunch of money in my IRA and then I'll pass it on to my family, well, you're just really deferring your taxes and your family still has to take it out. They can't keep it forever. So this is a change that has been slowly working its way through and evolving. And just as a reminder, and it's been clear, by the way, it's been clarified because originally we passed this bill or they passed this bill and then IRS didn't have what it needed. Secure 2.0 Act, Secure 2.0, these are things that are now in effect. So if you're not taking RMDs and you've got a little time and you are not going to turn 75 until tax year 2033, you won't have to start taking RMDs until you are 75 in 2033. The other item that we will see is that employers can add SEPs and can add Roths to SEPs. I mentioned about Roths and SEPs earlier. The other item is that, and this is great for those of you with 529 plans that have been open for more than 15 years. What we now have is a situation where money can be rolled from the 529 plan into a Roth up to 35,000, and that can be done penalty free, which is pretty beneficial, by the way. It sounds like it's a really small number and it's not impactful, but it actually is. So that's key. And then we've got some other deductions for folks starting plans and a couple of other little things, but nothing too major. And then we just have the Medicare reference guide for those of you on Medicare. This will give you a good idea about what your upcoming premiums are going to look like, how this is calculated, and it will give you an idea for what you need to look at. So, and I don't want to, because this is mainly me reading from the chart, we are going to share this chart. We will have it up on the website as soon as we can. This will go up probably with all of our other ADV documents in the course of the next month. If you're on the call or you want a copy of this chart, give us a shout. It is compliance approved, so we can send it out and share it with everybody. That said, because I want to be efficient with our time and not drag this out too much, if you've got questions, now's the time. Go ahead and send us an email, shoot us a text message on the text messaging app, and we'll try and get it answered. So I'm going to hang out here for a quick minute as I go through this, and we'll hopefully get a little bit more money, and you can see how your money works. So a couple little things here, just from an insurance standpoint. Make sure you go over this. Open enrollment's already closed. You already know what things are, but this is the key stuff for your own tracking. This is something I do want to kind of point out. For those of you with larger estates, 2025 is a year for estate tax planning because, or actually 2026 will be, and this is why you need to watch this, is that what we are seeing here is that the estate tax exemption is scheduled to change pretty dramatically at the end of the year. And so we'll need to know from Congress how that's changing. More importantly, this is the key thing. When it comes to estate tax planning, it's all about the rules that are in place when you pass away, not when you set up your trust and estates. So if you have more than $7 million, pay close attention to this because this could be problematic. All right, give me a quick moment. I'm going to stop sharing And I'm gonna see if there are any questions that have come through. All right, no questions so far on this side. We're gonna check this one. All right. We don't have any questions. So it looks like we got it all squared away. All right, last but not least, I'm gonna bid everybody adieu. Pay attention to all of this stuff. If you've got questions, feel free, specific questions related to your account, specific questions related to anything that was presented here today, go to our website, phillipsfinancialstrategies.com, and click the button for scheduling a meeting. And pretty much that's it. I will see you next month, and have a wonderful January. And if you're in DC, get out and enjoy the weather because it is going to be really gross a little bit later today when the rain starts to come in. All right. Have a great day, everyone. Bye-bye.